Hello, I'm Nathan Kubik, and thank you for joining us for the first quarter of 2020 Transform Wealth Capital Markets Outlook. I hope that everyone is staying safe, healthy, and erring on the side of extra social distancing. I wanted to take a moment to thank the unwavering dedication of our team. I would also like to express my gratitude for the discipline and thoughtfulness that we've seen in our clients throughout this incredibly difficult time. We continue to operate remotely without any impediments. We are doing so with the exact same efficiency, systems, and tools as we have in the past. We all stand ready to answer any questions or address any concerns. Please don't hesitate to email or call us just like you normally would. This outlook will be a bit different from those in the past. We will specifically be focused on the coronavirus and its impacts to the country, our economy, and the financial markets. We will also be discussing short-term and long-term implications and what we've learned from past experiences through different recessionary periods. From there, we will turn our attention to what we've been doing in response to these market conditions and how we are positioning from an investment standpoint in a number of our strategies going forward. 2020 started strong, with high expectations for earnings growth and economic prosperity. Those expectations quickly evaporated as the coronavirus changed everything. It took most of January and February for the pandemic to fully take shape. This was perhaps longer than it should have been due to poor information flow from China, and also as a result of our using past pandemics as a guide of what to expect. As the virus spread, Europe followed China's wake, but now infection rates appear to be slowing in much of Asia and Europe. If the US follows suit, we are entering the most critical 2-week period where daily new case levels will start to peak and hopefully begin to slow. A lot has happened during this quarter. Saudi Arabia compounded the world volatility by reducing oil prices dramatically. Congress, the White House, the Federal Reserve, and the Treasury Department all acted decisively, passing legislation in record time and implementing a much-needed economic relief stimulus, which should enable the U.S. to come out of this economically in a much better position. There's no avoiding the tremendous negative impacts from the coronavirus that we have witnessed over the past weeks and will witness over the next months, but actions taken should mitigate much of what could have been a dire economic recovery. Here, we see the progression of the coronavirus throughout the United States over the last 3 weeks of the quarter. State by state, we have moved from social distancing to shelter in place. The country has diligently worked to flatten the curve in efforts to not overwhelm our healthcare systems. This has ultimately been effective, but in many areas, the healthcare systems are being strained. Due to the dense population, New York City has become the epicenter for the outbreak. While the death toll in New York has been staggering, with 731 deaths, there is reason to hope that the outbreak could be slowing there. At this moment, there have been 2 days with fewer deaths, and the state is hopeful that that trend will continue. As we can see here, a strong government directive of shelter in place has been effective across the globe. We are not confident with China's data, but looking at Germany, Italy, and other countries, we see that infection rates have begun to slow. The US appears to be 2 or 3 weeks behind Europe in our current stage of the outbreak, and while it appears that New York may be slowing, most of the country is likely to see these levels beginning to peak over the next 2 weeks. Specific timelines are not clear, and unfortunately, as of right now, there are still many unknowns ahead. These unknowns are at the heart of the volatility we have seen in the markets. There are tremendous discrepancies in forecasts. Some of the key areas include the impact to earnings, to economic growth, and to unemployment levels. This has been seen throughout the world, with equity markets having fallen around the globe. At the beginning of the first quarter, we discussed the fact that valuations were slightly overvalued based on earnings levels. The consensus of analysts had high expectations for earnings in the latter half of 2020, and the markets were willing to pay higher valuations for that expected growth. Given the impact from the coronavirus, we now know that that growth is not a reality. The equity markets are always looking to what will happen in the future to determine appropriate values today by discounting those future expectations. The problem we are currently facing is that there is tremendous disparity in those future expectations. The questions that can't be answered with much accuracy right now are, how long will this go on? How long will the economy be partially shut down? How far will GDP decline as a result? How many will lose their jobs? How many will be able to quickly get back to work? And once this is all over, will life and spending patterns resume to where they previously were? The disparity in these expectations can be seen in this chart. On the left, we see historical GDP numbers. We had been in a Goldilocks economy with slow and steady economic growth. Looking at the estimates on the right, we see forecasts ranging from a 10% to 38% contraction. This is a tremendous difference, and a primary reason for this is the differing expectations for the amount of time that the economy stays shut down. As time goes on, we will gain clarity on this, and the differential will tighten. The bottom line is that the longer the economy needs to stay in partial shutdown, the deeper the impact will be, and the longer it will take to recover. Here, we look at unemployment level expectations. Similar to GDP, we see a wide range of forecasts. These two will continue to evolve, and the differential will tighten as we move forward. The CARES Act will go a long way in supporting the unemployed, and some are arguing that the legislation may actually increase unemployment levels beyond where they may have gone. This is for two reasons. One, some individuals will make more being unemployed than they would if they continued working. Second, some companies are offering employees the ability to step off their payroll, collect unemployment, and then be hired back once we are through this. This is not to diminish the tremendous benefits set forth by the legislation. In truth, the act was incredibly necessary and will enable the economy to rebound much more strongly. The act greatly increases the likelihood of a V-shaped recovery as opposed to a U or L-shaped recovery. This is just a side effect, and one that might make unemployment levels appear more dire than they might have been. It appears as though unemployment levels will dwarf that of the financial crisis, but those levels don't need to stay so large. If the CARES Act is effective, these levels should be temporary and not long-term. And where are most of those unemployment levels coming from? Some of the leading industries include hotels, restaurants, entertainment, and retail. Looking at the bottom left, we see the levels of employees in January within those industries. As new data is reported, we will certainly see a heavy decline within these industries, but there are also industries that will likely be looking to hire back those same individuals once we are through all of this. The chart on the right shows us the contribution of earnings to the S&P 500 by each of these industries. This too will see a meaningful decrease. However, these are also areas that should ramp back up relatively quickly should the stimulus package be successful in positioning for the recovery. Before jumping into the stimulus initiatives, we did want to comment on the oil price war that compounded an already volatile time in the markets. Saudi Arabia had proposed to Russia the idea of cutting oil production. The intention was to push oil prices higher. Russia opted against the proposal, perhaps to hurt the US oil business, and Saudi Arabia responded by slashing export prices and starting an oil price war. They wanted to get their way, and they believed that Russia would blink before they would. And they are probably right, as Russia is not as well positioned in this price war as is Saudi Arabia. This occurred during a time of already waning demand due to the coronavirus. Conversations have ensued with the US government officials and Trump, and it appears as though there has been an indication of a forthcoming agreement to end this price war. Throughout this window, the government has stepped in faster and stronger than ever before. It is truly incredible how much they have done already, and it is likely more is coming. The Federal Reserve has implemented a massive quantitative easing situation with their cutting the Fed funds rate to zero, and they have provided flexibility in bank capital requirements. They have created a massive funding facility to normalize the fixed income markets and to create liquidity for money market and debt instruments. They have created a bond buying program and have said that they have more arrows in their quiver and are prepared to use whatever is necessary. The CARES Act is pumping more than $2 trillion into the economy. Stimulus checks, enhanced unemployment benefits, forgivable loan programs, and direct aid are some of the factors. This is the most massive stimulus initiative we have ever witnessed, and it is likely that more is still coming. There is growing anticipation of additional stimulus measures directed towards individuals and small businesses. This gives our economy a very strong level of support to pick back up quickly as we get through this. This market decline was the fastest in history, and volatility spiked higher than it did during the financial crisis. We can see that volatility spike in this chart. Similar to when the government stepped in with the financial bailout, the markets moved higher at the moment it looked clear that Congress would pass the CARES Act. Again, this brings us back to the markets gaining clarity on an unknown. We are not convinced that the volatility is behind us, as there are still many unknowns ahead. But as more and more clarity is gained and priced into the markets, we do expect to see the volatility dissipate. The exact timing of this clarity gain is of course unknown. That said, it is important to understand how the markets price in this uncertainty, and a great way to do that is to look back in time at some different recessionary moments. On the left chart, we look at the financial crisis. We see the value of bank stocks in the S&P 500 represented in blue. The gold line represents the cumulative bank failures throughout that time period. What I want you to take away is that those stocks hit their bottom when only 8% of the eventual bank failures had actually occurred. And looking at the chart on the top right, we see the mid-70s stagflation era. Here, we see that the market bottomed long before the worst of the economic impact had occurred. In the bottom right chart, we see the same story during the financial crisis. Ultimately, as clarity is gained and unknowns become knowns, the markets begin to price in the recovery in anticipation of eventual economic growth. This is part of the reason why timing the markets proves to be a losing proposition over time. To further drive that point home, consider this chart. Here we look at the annualized return percentage and the growth of $10,000 from 2000 to the end of 2019. If an investor stayed invested during the whole time, they would have had a 6% annual rate of return and would have more than tripled their money. These numbers assume that you invested at the peak of the market in 2000, right before the tech bubble burst. But the point here is that missing only the 10 best days, they would have only received 2.44% return and would have ended up with half the money. Follow that to the right and you will see the magnitude of missing even more days. This should further point to the fallacy of timing the markets. Also remember that 6 of those 10 days occurred within 2 weeks of the 10 worst days, which is what we are seeing in this chart. Here, we look at different windows of time immediately following a large decline. This chart shows us 7 examples of days with the deepest declines that were followed by days with the greatest gains. These charts paint the picture of why time in the market works and why timing the market does not. That's not to say there aren't different ways to position for different market cycles, and this particular black swan event is no different. In actuality, this event has created a number of market inefficiencies that we believe will result in a great opportunity for wealth creation over the long term. So let's get into some of the things we've seen and what we've done in response. Throughout the first quarter, we maintained around a 10% overweight to growth stocks in our core equity model. As you know, we've been out of small cap stocks for some time. A bit surprisingly, large cap growth outperformed large cap value by more than 10% this quarter. Typically, in a major market downturn, we see a flight to safety and to value. In some areas of the markets, we did witness this, but as a whole, we did not see this from a style investing perspective. In fact, we have witnessed an enormous deviation in valuations across styles, sectors, and subsectors. We believe this has created some long-term opportunities. Let me explain. The next couple slides are a bit technical, but we wanted to share them as we believe there are some key takeaways. At the end of the first quarter, we saw companies with the highest level of free cash flow margins return significantly higher relative returns than the rest of the market. We see this in the chart on the left, And this has been and continues to be one of our most key factors in screening for portfolio companies. And this characteristic is generally more evident with growth-oriented companies. On the other end of the spectrum, we see those companies with the lowest quintile of free cash flow margins. These are typically value-oriented companies that have focused on generally paying dividends and are often slow and steady when it comes to growth. Clearly, the high free cash flow companies have dramatically outperformed that of lower free cash flow companies. Of course, this is just one of many factors that needs to be considered, but the dramatic differential during this period paints the picture for why growth has outperformed value. Now, let's explore what we are seeing with company valuations. Looking at valuation spreads in the market over almost 100 years, we see something extraordinary. Here, we look at the top quintile of price-to-book valuations compared to that of the average. When there is a difference of 2 standard deviations or more, this makes us stop and take note. The reason being that historically, this represents a meaningful opportunity to look at value discrepancies and reposition some holdings. In this case, we got as high as 4.5 standard deviation, which has only occurred twice in the last century, once during the Great Depression and the other during the financial crisis. We are now closer to 3.5 standard deviations, but this has historically offered great opportunity. Looking back in time at windows where we crossed over that 2 standard deviation line, we have seen large cap value opportunities outperform the rest of the market. This chart shows us the next year's relative return of outperformance compared to the worst quintile of valuation metrics. Taking this information into account and combining it with everything we are seeing from a fundamental standpoint, and we think this is an opportunity to shift back a bit towards value. And that is what we just did. Here we look at our core equity model style weights. We've updated this slide to reflect our weights at the end of the quarter, as seen in the top right, and we've added our new weights, as seen on the bottom right. Starting on April 1st, we determined to take advantage of a pullback to rebalance our clients' portfolios and make some tactical shifts based on opportunities we were seeing. The rebalance allowed us to shift back to your individual target weights, adding to equity exposure in a downturn. This is a core pillar of asset management, and it effectively trims stocks as they hit new highs and adds to equities in these downturn periods. In addition to the rebalance, we took this opportunity to shift from a 10% growth overweight to a 3% value overweight. This was one piece of our tactical moves, but a meaningful one, as we haven't shifted towards a value regime in many years. Sector weightings were another piece of our tactical moves. Technology, our largest overweight, continued to be the best performing sector this first quarter. The markets as a whole fell 19.6% for the quarter, and about half the sectors did better and half did worse. More defensive sectors like consumer staples and utilities fared well, where more cyclical sectors like discretionaries and industrials struggled. Energy has its own issues due to the oil price war, but interestingly, financials were also punished in a meaningful way. Some financials, like banks, were beaten up by more than 50% and were being treated like this was a financial crisis, which it is not. Opportunities like what we are witnessing in banks and other subsectors moved us to further our tactical repositioning. Here we look at our core equity model. We've added a new line so that you can see the changes we've made from a sector perspective over the first couple days of the second quarter. As we've discussed, we added a bit to financials, specifically the banks. We pulled back a touch on technology, but maintained our overweight. We added to healthcare, a sector that was cheap from a valuation standpoint moving into 2020, and we were starting to see some momentum there. We pulled back on our industrials, communication services, and consumer staples sector exposures. And we added holdings to utilities and materials. These changes were done with an extra focus on valuation and specifically targeting companies that we felt were beat up too far for what their fundamentals and positionings represent. A similar story can be seen in our dividend equity model. This strategy already has an inherent tilt towards value, and this tilt did drag on the portfolio in the first quarter. That said, this tilt also makes this portfolio well positioned for our outlook for the next stage. During this recent rebalance and tactical repositioning, we added to our financial, discretionary, utilities, and materials sectors. We reduced exposures to industrials and staples. In addition to this model's focus on strong fundamentals and valuation, this portfolio also focuses on dividend growth. As we enter a time period of incredibly low yields, the dividends associated with these companies should continue to look attractive and entice buyers once we are through this health crisis. While many types of bonds have not moved in lockstep with that of the Treasury curve, we do expect that correlation to move in line with historical spreads. We will get into that in a moment, but for now, let's look at where the Treasury curve has been and is now. As you can see, by cutting the Fed funds rate to zero, the entire curve has dropped by more than 1% from where we were at the end of 2019. There has been a flight to safety here, and Treasury bond yields are at very low levels. For example, if you purchased a 10-year maturity Treasury bond, your annual income is only 0.7%. While we expect to see all investment grades bonds follow this trend, we have not yet seen this in all types of bonds. In fact, in the bond markets, we are witnessing a meaningful window of disconnect. The reason for that disconnect was multifaceted. Hopefully you've had a chance to read the email we sent out detailing this opportunity as it began to appear. If you didn't, please let us know and we will resend it. Ultimately, we experienced an enormous disconnect between supply and demand due to panic selling, mutual fund and ETF forced selling, and the lack of demand due to higher levels of bond inventories and repositioning. In this chart, we see the tremendous levels of outflows from municipal bond funds. Without an equally sized demand for those bonds, the municipal bond pricing got squirrely for about a week, which can be seen in this chart. Here, we look at the highest possible investment-grade municipal bond yields for those with a 5-year maturity. On March 15th, the Federal Reserve cut the Fed funds rate to zero, effectively dropping the entire Treasury yield curve. Typically, you'd see a corresponding drop in yields in the muni markets. Clearly, the opposite actually occurred. Due almost completely to the lack of demand and the tremendous supply, muni bond prices dropped and yields jumped. This created a tremendous buying opportunity, and we burnt the candle at both ends to take advantage of this opportunity, as much of it as we could. We purchased all the bonds that met our criteria that we could, and a week later, the yield snapped back to more normative levels. We would argue that yields can come down a bit more and that munis should appreciate a bit further, but we are back to acceptable spread levels. The same cannot be said for that of corporate bond yields. Here we look at the spread, or difference, between Treasury rates and that of the corporate bond index. Prior to the coronavirus pandemic, corporate bonds traded with about a 1% higher yield than that of Treasury bonds. We saw that spread spike as high as 4% and is now near 3%. Similar to municipal bonds, there is a bit of a disconnect between supply and demand. However, the unknowns that we've discussed throughout this presentation do play a greater role with corporate bonds than that of municipal bonds. That said, look what happened during the financial crisis. As more information became available, those spreads snapped back to more normative levels. Additionally, in the meantime, investors were being paid greater yields as they waited. This same development, albeit to a lesser degree, appears to be occurring today. We believe this disconnect creates an additional opportunity in this asset class. We hope this presentation has been helpful in understanding some of the moving pieces in the economy and the markets. We also hope that we've been effective in showing you some of the opportunities we've been seeing and how we've been positioning to take advantage of these market dislocations. In conclusion, while there are many unknowns out there, each day brings us a little closer to gaining more clarity and one step closer to getting through this difficult time. We remain focused on potential risk exposures and are prepared to reposition again should clarity of information shift risk exposures further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, please stay safe, and we look forward to speaking with you soon.